there's a new bank in town and you are a reputable contractor from the town. You deposit $1 million to the bank and now there's $1 million in the bank's vault. Lucy from the same town wants to open a restaurant. She needs $1 million to do the renovation and extension. She doesn't have that money. She borrowed $1 million from the same bank. The bank then credit the money into her account. She then hires you to do the renovation job. After the job is done, you deposit the $1 million you received from Lucy back to the bank. Now let me ask you, how much money do you have with the bank? Right, $2 million. How much money is actually sitting in the bank's vault? Right, still the $1 million. This process can go on for a few more times. If the reserve requirement for the banks is 10%, the loan can multiply money by up to 10 times. It means that the bank can loan $10 for every $1 it possesses. It is called fractional reserve banking. It is a common practice in modern banking. Now, what happens most depositors withdraw their money from the same bank at the same time? The bank will collapse. Any bank will collapse under that scenario, and that happened last month. I know research houses are reassuring that the impact is not contagious, but that shouldn't be misinterpreted as not having impact. Just when the world stock markets were spooked by the banking crisis, Topgolf announced its another terrible quarterly report, but it somehow lifted the stock prices of the entire industry, with many research houses are now saying the worst is over. What is going on there? Hi everyone, I'm Mr. Dev from the Modern Reminder. Welcome to the Market Highlights. In this series, I would update the interesting event that happened recently and see how we can position our portfolio according to this event. Now let's see what happened in March 2023. Silvergate Capital got into trouble for reasons that were mostly crypto related, including the money laundering, its involvement with FTX, the crypto platform that went under. Also, it is a relatively small bank. Credit Suisse, on the other hand, is a large international bank. We can't afford to see it collapse. But it has been plagued by long-running problems and not really connected to the bank runs in US. Lucky for us, at the time of making this video, UBS has agreed to take over Credit Suisse, and the fear of banking crisis has subsided, at least for now. What is interesting is the collapse of SVB, Silicon Valley Bank, and how it led to the collapse of Signature Bank. SVB specialized in providing banking services to technology firms, venture capital firms, and the startups. It banked nearly half of these companies that went public in 2022. Many of these companies raised a lot of funds during the COVID-19 pandemic because back then interest rate was low, capital was cheap, and the market was flush with liquidity. They then deposit the money that they raised with SVB. Suddenly blessed with a huge amount of deposit, SVB invested them in long-term treasury bond and mortgage-backed security. That exposed them to high interest rate risk. Remember, there's an inverse relationship between bonds and interest rate. As the Fed started to hike the rates aggressively to counter inflation, it eroded the value of these long-term bonds that were issued during the era of ultra-low interest. SVB could have hedged the interest rate risk away, but they didn't do so. These investments that they made are investment graded, very safe investment. I guess SVB planned to hold the bond until its maturity and get their capital back without anyone noticing. That could have worked, but life is not all sunshine and rainbows. With rising interest rate, the venture capital and market funds started to dry up. Remember, this technology company, these startups are usually highly leveraged and weak in operating cash flow. So they were forced to draw down their deposit held with SVB to pay their employees, pay their suppliers. As the pace of withdrawal accelerated, SVB had to sell some of its bonds at losses of $1.8 billion to meet the withdrawal demand. It also tried but failed to raise funds through outside investors to cover the losses. That alerted the market. Founders Fund and other high-profile venture capital firms advised their portfolio companies to pull their money from SVB, resulting in the bank run. Spooked by the collapse of SVB and being identified as the next weak link, Signature Bank also suffered a bank run as customers pull money from it. What are the impacts? Most analysts deem the bank runs in US are not contagious because, first, SVB is a unique case where most of its customers are technology firms, capital venture firms, and startups. while other banks does not have this kind of concentration risk. Second, in US, banks with assets not more than 250 billion US dollar are exempted from strict regulatory measures, including the capital requirement and liquidity requirement. Silvergate Capital, SVB, and Signature Bank are one of those banks. So the liquidity issue faced by them are not seen in larger banks. The most recent round of stress tests by the Fed in June last year showed that US banking system can absorb losses of more than 600 billion US dollar. Third, FDIC has announced that they will fully protect the depositors of SVB and Signature Bank more than the usual threshold of 250,000 US dollar. The Fed also set up bank term funding program to offer banks 1-year loan with collateral value at par, so that smaller banks will not face the same liquidity issue. These are all logically right, but the problem is the market is not always logical. Ever since the incidents, the US bank deposits are declining. That is surprising. At first, I thought we would see depositors move their funds from smaller banks to larger banks. But now it seems like there's a switch from bank deposit to money market funds. If this continues, it will seriously impact the bank's ability to lend, further tightening the lending standards. What is worse, with the collapse of SVB, there's a hole in the funding market, especially in the tech sector. This will put more pressure on the technology firms that are already tight in cash flow, and might result in more layoff and insolvency in the tech sector. That will create a ripple effect throughout the entire market. As for Malaysian Bank, there's no spillover effect. The investment security held over total asset by the Malaysian banks is not more than 25%. Even in an unlikely scenario that Malaysian bank have to sell the investment securities, the capital requirement ratio will still be very healthy. If you want more details about it, you can PM me. One thing I like to point out is that the rising of interest rate is starting to hurt the bank, at least in the US. I've mentioned it in January highlights that this will eventually happen. We might see an earlier than expected pause in the Fed's hike cycle, which reiterated our view that the net interest margin of the banks will be compressed. Now move on to the growth industry. How can a quarterly report from Top Growth lift the stock prices of the entire industry? You see, Top Growth is a market leader of the growth industry, and it is a rather generic industry. It means that Top Growth being the market leader, if it sees things are getting better, it is not only for them, but to the entire industry. Also, when Harta Lega, KOSSAN, SUPERMAX released their latest quarterly report in February, that was for financial period from October 2022 to December 2022. Those were like history, like who cares? But the latest release from Top Growth covers the financial period from December 2022 to February 2023, which shows the latest development in the industry. Having a look at the latest result announced by the Big Four, we can see that they are not only terrible but way below our expectation. That should have caused another round of sell down. What is causing the opposite to happen? In the report, Top Growth is looking to increase the average selling price, ASP, to $21 per 1,000 pieces, which is more than 20% hike. Some may think that it is because of this increase in ASP, we will be able to see improvement in earnings from next quarter onwards. Not so fast. The ASP has been revised to pass through the increase in costs, including the natural gas, wage, raw material costs, and electricity tariff, which has increased 42% January this year. So the increase in ASP doesn't necessarily warrant an improvement, but it is the message behind it that is important. Let me digress a little. My uni professor once said that you can summarize economics into two words: demand and supply. In a free market, demand and supply will always find its equilibrium. The pandemic created a high demand for growth, and that demand led to oversupply. It is just a matter of time before it finds its equilibrium again. Based on a few signs, we believe that the inflection point may have started already. Raising ASP is one of that signs. It means that the growth producers are at least taking some bargaining power back. This is reassured by the Chinese growth producers are also repricing their growth. The second sign is that from Top Growth's latest report, we see that sales volume grew 6% quarter on quarter, showing signs of inventory replenishment. It is estimated that 131 billion pieces of glove that was purchased during the pandemic were in excess of the usage, which account for 1/3 of 2023 global demand. We think that this excess inventory may only be completely exhausted by 2024 to 2025, So this is only a starting point. It is not much, but it is the message behind it that is important. The third sign is that the market consolidation is already happening. New entrants and smaller producers like Aspen Group, VIP Glove exited the market already. The established producers are retiring their less efficient and aged production line. Even though the exiting capacity is minimal, but it signals the bottoming out of the industry. One thing I need to point out is that even when the equilibrium is reached, we need to do some discount at the earnings because the China growth producer has already taken a market share that they didn't before the pandemic. The revised ASP of top growth is $21 per thousand pieces compared to $17 per thousand pieces for the China growth producer. The cost advantage came from the use of less environmental friendly but cheaper coal as the source of energy. The current industry utilization rate is about 40%. It may well take more than a year before the demand and supply reaches equilibrium. But here's the thing with stock market, you can't wait until that time because by then, the share price would have gone up a lot already. So start buying in now, in batches. When we say the worst is over, it is more like a figure of speech. It doesn't necessarily mean that the earnings will improve from next quarter onwards. But a few signs are showing that the journey to recovery has already begun. Don't rush into the market, wait for price correction. It will happen because as I pointed out, the recovery path is a long one. As to which growth counters, I advise you to stick to the big four. I prefer Harta Lega. That is all for the market highlight of March 2023. To keep the video length to about 10 minutes, I have to speed things up and skip some details. If you need more clarification, you can always PM me by clicking the link to the Google form below. If you like this video, you don't do the usual, share, like, subscribe. Until next time.